If you're on social media like me or you read about personal finance online, you're probably hearing a lot about Roth IRAs and Roth conversions. Well, this week I want to talk about Roth conversions and whether or not they make sense for you. We'll also dive deeper into discussing how they work, who can do them, how you know if they benefit you, and how to actually process them. If you're new to my show or my channel, my goal is to help teach you in each episode how to save for retirement, how to plan for retirement, how to invest for retirement, and how to pay less taxes in retirement. If you want to learn more, please subscribe to my podcast or video, or you can also consider taking my online retirement planning course. It's called Retirement Readiness on Demand. If you're 50 and older and want to get a plan in place for retirement, then you should consider signing up for this valuable course. It has over 7 hours of material and a helpful checklist to help you get started in planning the ultimate retirement. To learn more, head over to retirewithryan.com and click on courses and click on Retirement Readiness on Demand. Now, most people would agree that having tax-free income in retirement is preferable over having taxable income in retirement. After all, who wouldn't want to not have to pay any income tax on their income in retirement? However, for many people in their 50s and older, this is not a possibility. The primary way that most people have saved for retirement has been through pre-tax 401k, pre-tax type retirement plans, which means if you don't pay tax when the money goes into these plans, you will then pay tax on these plans as you withdraw the money, as you take income from them or distributions. And when retirement plans were first established, one of the main benefits for companies setting these up and for employees was that you received a tax deduction when the money went into the plan. Therefore, because you received that tax deduction, you pay tax when the money comes out. Now, the other benefit, which you're still getting, is tax-deferred growth, which is a major benefit because that means that as your money grows in these plans, any capital gains you have, any dividends you receive, or any interest you receive is not taxed. So that helps your money to compound faster because rather than you paying tax on that money every year, that money is staying in your account and is helping you build the value of your account. It wasn't until 2006 that companies started to be able to offer Roth 401ks to employees. And the Roth 401k contribution limits, I think, were around $15,000 when they first came out, which were the same amount as pre-tax 401k plans. And the Roth IRA was created well before that in the 1990s, and that contribution limit for when it first started out was about $2,000. So really, most of people's money that has gone into retirement plans is on a pre-tax basis. So if you're in that boat, if most of your money is pre-tax money, one way that you can get that money to be not taxable, or really the only way I should say, is by converting some of that money over to a Roth IRA. So that's what I want to discuss today. So first of all, what is a Roth IRA conversion? Well, this is where you're taking pre-tax money, pre-tax 401k, pre-tax IRA, SEP, simple, profit sharing, any pre-tax money that you have, and you're going to then pay tax on it at your current tax rate and then be able to move it over into a Roth IRA. So the taxes that you pay depend upon the current tax rate that you're in. So let's just say you're going to convert $50,000. You're going to pay 12% federal tax on that and 5.5% state tax. Well, that's the tax that you would pay on the conversion. And then now you're able to put that over into your Roth IRA. And then when you take it out of your Roth IRA, providing you follow a couple of rules, which we'll talk about, that money would be taxable to you. So then moving on to the second thing, who can actually do this? Well, anyone can do a Roth conversion. Anyone that has pre-tax retirement funds can do a Roth conversion. And one of the main things you have to keep in mind, though, is anytime you do a Roth conversion, and every time you do it, it starts a new 5-year holding period on the money. So meaning that if you want to take that money out, all of it out, within the first 5 years of doing the Roth conversion, you could end up having to pay taxes or penalties on the gains on the conversion. So you have to keep that in mind, that if you're doing a Roth conversion, one of the things you want to be able to do is not touch this money at least for 5 years, and preferably wait until 59 and a half, age 59 and a half, until you want to start taking money out of your Roth IRA. When you do the conversion at the end of the year, you'll get a tax form called 5498 that comes from wherever you did your conversion, the custodian. So if it's Charles Schwab, Fidelity, Vanguard, they will mail you a form, and that is one way you can keep track of these conversions. So keep in mind that the way that Roth IRAs are taxed is your contributions come out first, tax-free. Then the converted principal comes out, and then earnings. So you can always take out your contributions tax-free at any age, which is one of the great things about a Roth IRA, where you can take those contributions out. If you had an emergency, you could take the money out and not pay tax on it at any age. But then when you went into the converted principal or the earnings is where the taxes or penalties could apply. So one strategy that people can use is they do what's known as a Roth conversion ladder, where they convert a certain amount of their Roth IRA every year. Let's say you started out converting 20,000 and the next year 30, then 30 again. Once you've done this for 5 years, then you've already met the 5-year period on that initial conversion, so that if you needed access to that $20,000, let's say, you could take it out without any penalty because you've made it past the first 5 years. It would be once you started getting into the other converted money that wasn't 5 years, or until your gains, if you weren't yet 59 and a half, that taxes or penalties could apply. So that brings us to the third thing I want to discuss is who can benefit from a Roth IRA conversion. Well, a lot of people. Certainly people that are in a low tax bracket now and believe they'll be in a higher tax bracket in the future. That's probably the hardest thing to predict. What are our tax rates going to be in 10 years or 20 years or 30 years or 40 years if you're younger, when you're going to start to take the money out of these accounts? If we knew that, it would be a very easy decision as far as whether to convert some of your money over to a Roth or not. But we don't. We can make assumptions. We can look at where tax rates have been over the last 10, 15, 20 years or longer. We can make assumptions about the future, where we think tax rates will be just based on our country. I've said this in other episodes, we owe a lot as a country as far as our national debt. And if we're ever made to pay that back in a short period of time, or maybe ever, that could drive our tax rates higher. So if you thought tax rates were going to be higher in general, then it could make a lot of sense to do a Roth conversion, because you could convert at a lower rate now and then avoid paying tax at a higher rate because you'd be taking that money out tax-free, so there'd be no tax. Anyone that wants to avoid required minimum distributions could be a good candidate for Roth conversions. Required minimum distributions are a minimum amount when you reach 73 that you have to take out of your IRAs or 401ks. So any money you convert in advance, that's not subject to a required minimum distribution. If you want to leave a tax-free inheritance to your family, it can be a great way to do that by doing a Roth conversion. You pay the tax now for them, especially if your family or your children, you anticipate being at a higher tax rate when they would potentially inherit your IRA monies. That could be a big savings for them. If you want tax flexibility in retirement, if you just want to not have to take out a certain amount of your account every year due to required minimum distributions, or you want to just be able to take money from different accounts that are tax-free versus taxable, then a Roth conversion can make sense for you. If you're a high earner and you have a lot of pre-tax retirement funds, you have a large IRA balance that you're not really probably going to use all of. You've got multiple millions in IRAs. Maybe you also have a pension and Social Security. Then a Roth conversion could make sense for you, because maybe this 401k money you're not going to fully need and you want to leave it to the next generation. If you find yourself in a year where you have unusually low income compared to your general earnings, or also compared to what you think your future earnings are going to be, like one year you decided to take a sabbatical from work, or you're in between jobs, or you took a year off, for personal reasons. Whatever that is, that could be a great year to do a Roth conversion, because you could potentially convert at a much lower tax bracket than if you're doing conversions in other years where your income is higher. And those especially who can pay the taxes on the conversion from outside accounts. What do I mean by that? Well, if it's going to cost you, let's say, $6,000 in taxes to convert your Roth IRA, or the amount you want to convert, and you could pay that from a separate account, a bank account, savings account, that's meaning you're not taking that $6,000 from the amount you're converting, it's going to make even more sense because then more of your money is going to be going into the tax-free bucket versus not. If you have to take $6,000 out to pay the taxes so therefore you want to convert 50, but you're only converting 44,000 because you have to pay the taxes from the conversion, then it's not going to be as powerful as if the whole 50,000 went in and that's all growing on a tax-free basis. So how do you determine your break even? That's something that people wonder about. What is the break even? Like, how long does it take me to catch up? There's some calculators out there. And, if you're handy with a calculator or Excel, you can do it yourself. So if you're wondering, how do you do a Roth conversion? Well, there's a couple steps. So first you have to open a Roth IRA wherever you're going to do the conversion at. So let's just say it's Charles Schwab. That's who my company uses to hold their clients' money, our clients' money. Then you'd want to get your money you're converting to the Roth over to Charles Schwab. So if you already had an IRA at Charles Schwab, great. You already are set up. If not, if let's say you have an IRA somewhere else or you've got an old 401k, you need to get that money over to Schwab. So either transferring your IRA over to Schwab or maybe you need to do a 401k rollover. So you call up the 401k provider, you request a rollover. They then either send the check to you or they send it to Charles Schwab. You deposit it into your account and now you've got that money in an IRA. So then you want to determine how much are you converting and are you going to pay the tax from the conversion or are you going to pay the tax when you file your taxes, when the tax filing deadline comes. So you fill that paperwork out, submit it to Schwab, and usually within 2 to 3 business days, they're going to have that money. They're literally just moving it from the IRA over to the Roth. And if you tell them no taxes withheld, then the full amount gets moved over. If you tell them to pay the taxes from that, then they will withhold the state or federal tax. And then the next step is make sure you invest the money. If you just convert it over, a lot of times you're converting cash, it's not invested. So the biggest benefit you get on this Roth conversion is investing the money and having it grow at a high rate in the future. So there, you want to make sure you invest it. And then you also want to make sure you properly report this on your taxes, especially filling out Form 8606, which is an important form for you to denote you've done a Roth conversion, but also for tracking it going forward. So lastly, what should your plan be for executing on these Roth conversions if you think you want to do them? Well, definitely reviewing your retirement accounts to see how much you have in pre-tax versus Roth. And if most of it's pre-tax and you think you're going to be in a higher tax bracket in the future, then consider doing a Roth conversion. Meeting with a financial advisor and or your tax planner can be very helpful. So you can start to map out what your income is now, what might your income look like in the future, and are you going to be in a higher tax bracket? Can it make sense for Roth conversion? Do you have enough time to benefit from the taxes you're going to have to pay on the Roth conversion? And then next, as I said, do you expect to be in a higher tax bracket in retirement? If you're in a lower tax bracket now, could be a great time to do a Roth conversion. And then after you've kind of determined that these Roth conversions might make sense, then you really need to review your income annually. This is where your financial advisor and or your CPA are very helpful because they can help you review your income annually and see how much conversion you might want to do. Maybe you might want to convert right up to the 12% tax bracket so that you totally take advantage of that lower tax rate. Or maybe you might want to convert even above that tax bracket if you're really trying to leave a legacy or you find that you'll be in a higher tax bracket in the future. So also anytime you have low income, if you lost a job or there was a major change in your income, this can be a great year to do a Roth conversion. But keep in mind also, anytime you're doing Roth conversions, this could have other tax consequences. You could be in a higher tax bracket, potentially. You could have to pay more for Medicare premiums, as something called IRMA I've talked about. So there's a lot of things to consider. And as far as good years to do it, I mentioned when your income's lower, also early on in retirement. If you haven't yet started collecting Social Security, this can be a great time to do Roth conversions because your income is theoretically lower than when you start collecting Social Security and that starts to get added to your taxable income. So I hope this helps on understanding Roth conversions and mapping out a plan for Roth conversions. As always, if you have a listener question you want to have considered for a future episode, head over to retirewithryan.com and click on Ask a Question. Have a great week, and I look forward to talking with you next Tuesday. Take care.